All right, ladies and gentlemen, today we have Adam Koos, who is the president and senior financial advisor of Libertas Wealth Management Group. And he is a certified financial planner and one of only 1,700 active chartered market technicians worldwide. A certified financial technician via the International Federation of Technical Analysts and a certified exit planner advisor. He's been named by Columbus Business First as one of their 20 people to know in finance, was a recipient of the 40 Under 40 Award, ranked by Investopedia as one of America's top 100 most influential advisors, and the winner of the coveted Better Business Bureau Torch Award for Ethics and Trust. Mr. Koos serves his clients as the president, senior financial advisor, and portfolio manager at Libertas Wealth Management Group, a fee-only fiduciary registered investment advisory firm located in Columbus, Ohio. Adam, we're so happy to have you this afternoon. The floor is yours.
Awesome. Thank you so much. That was an incredible introduction. I appreciate it. All right. So I'm going to start right off the bat by saying I'm going to move pretty fast here. And we did confirm that everything here is being recorded. So even though I'm going to move really fast, I'm going to do that on purpose because I have a lot of content I want to cover. So if you want to watch back any of the material using the recorded version after the fact, once this is all over, you can always stop, rewind, rewatch. And of course, if we have time for questions at the end, we'll offer time for Q&A. And then you can always, of course, email me personally if you have any questions about anything at all. So let's jump into our agenda. First and foremost, we'll talk a little bit about probably one of the most important things when it comes to building portfolio models, and that is knowing your time frame. And then the second would be knowing the primary trend on that time frame. Second is the 3 ways to screen for potential buy candidates using relative strength. The next thing we're going to talk about is what I call the wonderful world of exit strategies or trapeze nets below our feet. We're going to talk about using relative strength ranking as a risk management tool, so as opposed to just exit strategies, using RS as an exit strategy itself. And then I have some closing comments and slides and things that I wanted to share just about the markets, building and running portfolio models, and risk management in general to close out. I start almost every presentation I do anytime with a quote because I collect quotes. I love them. And today, I think a perfect quote, especially in the middle of a bear market that we're living in today, is by Van Tharp. He's an author, a trading coach. He said, "A mistake is when you don't follow your rules. And if you don't have rules in trading, then everything you do was a mistake." And I stole this from the chart report, Patrick Dunawilla, so thanks for posting that. But this is a quote that I think should be on everybody's monitor, a post-it note near wherever you do your trading, or if you're a portfolio manager, I think you always have to remember this, that you have to have rules and you have to follow them. And if you don't have rules, you don't have a strategy. So let's get into the main material here and talk about time frame and trend. One of the people that I respect who probably does some of the best work on time frame is Brian Shannon of Alpha Trends. He's at alphatrends.net, but he, if you don't know your time frame, then you're going to be forever lost in the market. You can't trade over multiple time frames, but you need to understand multiple time frames. And you need to know, are you a trader or are you an investor first and foremost before you build any portfolio model? And if you're an investor, you might own an investment for years. But if you're a trader, by definition, you're either going to be a day trader, a swing trader, or a trend follower in one way, shape, or form. So as an example for different time frames, I'm just going to pick one stock here. This is Exelon Corp. In the case of a trend follower, in this case, a trend follower might look at weekly charts where every candlestick is 1 week. If it's a dark candlestick, that means, as Matthew Verdal says, it's a heavy candlestick, it closes at the bottom. If it's a empty candlestick, that means it's light, it's hollow, closes at the top. But anyway, point being here, this is a weekly chart of Exelon. It's in an uptrend, so a trend follower might look at this and say, this is a chart that I would follow. This is my time frame, maybe intermediate term. A trend follower might also look at daily charts. Maybe they're a little bit more nimble. They're looking at daily charts, intermediate term moving averages, like this moving average right here, which is a 21-day moving average. A little fast for me personally, good as a reference, but that might be another example. And then you have your swing trader. I mentioned Brian Shannon, one of the best, in my opinion, swing traders out there. You might use 15-minute charts where you're holding a position for 1 week, a matter of a couple of days up to 3 or 4 weeks is all. But the bottom line is you have to pick a time frame that you're going to trade on and build your models from, and you need to stick with whatever that time frame is. So, to move on a little bit further here, your investor is probably going to buy and hold for the long term, weathering the storm, so to speak. So when I think of buy and hold, I think of strategic models, static models that stay in the market. When I think of traders, on the other hand, again, your day trader is going to hold positions for minutes to hours. Maybe they might even go to cash at the end of every day. Your swing trader might be days to weeks. Like I said, hold a position for a few days up to a few weeks, but they're also going to be really, really nimble. And then a trend follower is going to be somebody, and this is what I do. I manage both strategic and tactical models. Is going to be somebody who holds things weeks to months. They're going to be nimble but patient at the same time. So it's kind of in the middle between what we would call an investor and a trader. Again, I personally run both trend following and strategic models, and my time frame is intermediate. So I'm looking at, between 6 and 12 months is my time frame, just so everybody understands as we go through these things. Most of what I show you is going to have to do with an intermediate time frame. A couple of alerts, have a few of these slides like this. So you have to know what the primary trend is, because there's a difference between relative performance and absolute performance. Just because a stock, a sector, or an industry group is outperforming, it doesn't always mean it's going up. It could be the utility sector, which is maybe outperforming the S&P, but it's going down. In other words, it's the cleanest dirty laundry. So that's where trend following comes in. So if the primary trend is up or down, you got to figure that out first. So when we're looking at this chart right here, the S&P 500, and by the way, I built most of these charts last week, so they're a few days old. But you have to ask yourself, is the primary trend up or down here? We're looking at a 200-day moving average on the S&P. This, to me, the primary trend looks down. I don't want to talk too much about RSI today, but I also have an indicator I was looking at here that tells me that while the primary trend is down, we're also seeing relatively strong momentum, or at least defensive momentum, that could indicate that maybe we could see a bottom in the near future. But the bottom line here, again, is once you know the primary trend, and whether the trend is up, down, or trendless, because there is a such thing as no trend, you can then dig deeper into other methods of technical analysis. Again, like this one on the bottom here, and looking at RSI and looking for different pieces of evidence. So in addition to trend, you can look for previous levels of interest. You might look at, ceilings of resistance or floors of support. And what I've drawn here are just a couple floors of support that go back to the 2020 highs here at the end of summer, beginning of fall, which could be a bottom that maybe the market would find. And if it breaks through that floor, perhaps the next best potential floor of support might be the COVID highs. And that would be another logical place for the market to top. So those are things that you could look for when you're looking at the market as a whole, before we even get into models or building a model. But the bottom line here is, if you know the trend of any investment, it can keep you out of a lot of trouble. I know Kathy Wood's gotten a lot of press here. I feel a little bad for her because she's done so well, but then she's done so poorly recently. But down 73%. If you understand the primary trend of any investment, again, you can avoid losing money like this, as opposed to just becoming married to an investment. Not just stocks. We looked at Kathy Wood, but here's the bond market here in the US, down over the last couple of years, 14% when I posted this chart. Here's corporate bonds, down 27.3. I thought that we all agreed in this country that bonds were safe. Turns out that's not the case anymore. So this last 2 years, corporate bonds have been pretty tough. And then understanding the trend can also get you and keep you invested in what I call the playoff teams, all while avoiding the rest. And when I say playoff teams, what I mean by that is that's what relative strength is all about. Relative strength to me is all about staying invested in the playoff teams and avoiding the rest. And what that means is we're never going to try and buy the Super Bowl winner or the national champion. It'd be nice, if we could pick the winner, but instead I'd rather buy all the playoff teams and know that I'm going to own the champion, but I'm also going to own a bunch of other teams as well that have done pretty darn well. And then I'm also going to avoid a lot of the stuff that hasn't done so well, as opposed to just diversifying across the board. In other words, we want to concentrate, not diversify, but concentrate our positions in the strongest stuff based on whatever your model rules happen to be. Here's another example, the commodity index. So this is something that obviously has been in a pretty strong uptrend here for quite a while. More recently, it's breaking down. We'll have to see if it holds support, but so far, it's been a pretty good long-term investment, call it intermediate-term investment. This is food and beverages, relatively strong. You can go back to 2021 and it's been flat since then, but on a relative basis, it's done better than most of your major market indices, such as the NASDAQ, Dow, and S&P. Here's energy. Obviously, energy has been, call it a beneficiary of the commodities markets and inflation, pulled back recently, but energy has been a good investment to own. It's been one of the playoff teams. Oil and gas, right along with energy, kind of goes without saying, also been a good investment. Dollar Tree, digging down into a couple individual stocks here. Dollar Tree has been one of the highest RS ranked stocks for, and again, the intermediate term for quite a while here. AstraZeneca, Again, relatively strong position to own. And then United Health Group, here's another one. So I just wanted to burn through a few charts here to show you that there's a huge difference between the teams that are, 1-15 to end the season, or not to mention call it 1-7 in the middle of the season, and the teams that are maybe have a winning record. And that's what we want to do, is we want to stay invested in those teams with a winning record. So how do we do that? Well, there's a few ways to do it. As the saying goes, there's a few ways to skin a cat. So one way you can do it is through using rate of change. So in software that I use, I have a rate of change that uses 26 weeks. It looks at the past 26 weeks rate of change, and then I break them into deciles. So what you might do is you might say, well, I want to buy the top 5 or 6 or 7 or 10 positions within that screen. And then the sell side we'll talk about a little bit later, but that's going to get you invested in the playoff teams. Now, one thing you want to watch out for is over concentration, because, as you can see here, you got energy, oil and gas, small cap energy, oil refiners, solar, a little bit different there, obviously, with solar, clean energy. But that top 4 is very highly correlated. So you want to make sure you don't get yourself into trouble by buying something that's, all correlated, or a portfolio that's fully correlated. But if you look over here at the right, it's pretty obvious to see what you shouldn't own. Right now, over the last 26 weeks, you can see here that this is based on last week's activity, that online retail, innovation, robotics, blockchain, Bitcoin, and cannabis have just been terrible investments to own. And all the studies that have been done in relative strength say that growth tends to beget more growth. And, so the investments that have performed well over the last, we'll call it 6 to 12 months, have a tendency to continue to perform well over the next 6 to 12 months. Now, the further out you go, 18 months, 24, 36, that starts to change quite a bit. But that's the whole point of staying invested in whatever the trend is, or in this case, with the playoff teams using relative strength. Here's another example using rate of change, except I'm looking at international investments. So here the top, we'll call it 6, the top decile in my inventory is Chile, Saudi Arabia, Brazil, Portugal, UAE, and Hong Kong, which on a relative basis have done better. But when you compare that to the US markets, they haven't performed as well. And a lot of that having to do with the US dollar, but that's beyond the scope of this presentation. Bottom line is, you're better off not staying away from international right now. And especially if you look at the bottom of the playoff teams here overseas, they have not done so well, obviously. So that's the first way to screen, is through rate of change. The second way to screen is using what's called point and figure charts. Most of you watching have probably heard of a point and figure chart. This one uses a 3-box reversal method. This is just the S&P 500 using a point and figure with 45-degree angles. I don't care so much about the chart today as much as I do about the matrix. So here's a point and figure matrix from Dorsey Wright. Their software, when you look at buy signals, we're taking time out of the equation. So if you're somebody who doesn't care so much about time, and you're more concerned about direct relative strength and price only, then you might want to look at a point and figure comparison. This is a matrix. So here you can see the top relatively strongest, or playoff teams, when it comes to PnF, or PnF Matrix, is your solar stocks, energy, lithium, genomics, and so on. The bottom ranked stocks, again, blockchain, top 50 growth stocks, IBD, uranium, cannabis, and junior gold miners. If I show you another matrix, this is fixed income. So this is bonds. The top 3 positions here. So short-term tips, we've got TBX and TBF. So in other words, the highest ranked, or the playoff teams for bonds, are actually short bonds, TBX and TBF, which are short 20s and short 10s. You go to the bottom of the bond matrix and you're looking at I bonds, government bonds, and so on. But again, when we talked earlier about relative performance versus absolute performance, we have to understand that just because an investment might be outperforming toward the top, like short-term treasuries here, doesn't mean it's actually doing well. It could be going down on an absolute basis. For example, TLT. This is the 20-year treasury bond, which is down, as of last week, it was down more than 31% over the last couple of years, which is not, something we would own in a growth portfolio, but excuse me, even our conservative clients, conservative investors, they're not going to want to be invested, at least they shouldn't want to be invested in something that's on a relative basis and an absolute basis going down, even if they've been taught their whole lives that bonds are safe. The third method we can use to screen for stocks or ETFs are what are called relative rotation graphs. This is from Julius de Campanere. He invented this about, I could say, showed up on the Bloomberg terminal about 11 years ago, I believe it was. And Julius has just done a brilliant job of combining trend, velocity, and then we're able to study that information to determine what investments are weakening, what's strengthening. So if you look at this graph, what you're looking at is if a stock is in the upper left-hand quadrant, it's improving versus the market. The market's at the 0 point on the x-axis. If it's in the upper right quadrant, we're beating the market or leading. If it's down in the lower right quadrant, we're weakening versus the market, and the bottom left is lagging the market. If we go forward, this is an animated relative rotation graph of the stocks, 30 stocks in the Dow Jones Industrial Average. And what you can see, I did a 52-week animation here. So the date is in the upper left-hand corner, and you can see as time goes on, you can see that generally speaking, that these stocks all rotate, not all, but generally speaking, they rotate in a clockwise fashion. So the studies that have been done have shown that one of the best places to purchase stocks is when they're in the lower left lagging quadrant, coming out of that quadrant into the improving quadrant, or in other words, pointing northeast, or with a heading of northeast, I should say. So this would be a good place to get candidates if you're looking for some stuff that maybe has been beaten down or has been a relative underperformer recently. And then from there, you can decide what kind of exit strategy you want to use once you're in the position. Here's the same RRG concept, but this is the S&P, which is a problem because this is a really, really messy RRG because we're talking about more than 500 stocks. It'd be really, really difficult to kind of see, what it is we want to buy here. So what we can do to make our lives easier is we can use a filter. So I used Optima to create a filter for myself to show me only the stocks in the S&P 500 outside of 2 standard deviations, which is this circle right here. Because, if you want to buy outperformers, then the higher probability of an outperformer is going to be further away from center. And I only want to see arrows pointing northeast. In other words, arrows pointing toward the improving and leading quadrants. So this is as of last week. We had Netflix coming out of the lagging quadrant, Align Technologies, Etsy. PayPal was kind of in the improving quadrant, weakening, almost like it was headed back to lagging, and then turned back around and it's heading back northeast again. And you can look at all the other stocks here as well. And then before we buy anything though, when we're looking at relative rotation graphs, we always need to look at the chart. We can't just blindly buy a stock because it's improving or because it's beating the market. What we want to do here, and this is a relative rotation candlestick chart. You can see the candles that I used over here on the left. I'm colorblind, so I had to customize these so that I could see them. I can't use red and green. So you can use whatever colors you want, but here's the leading color for a leading quadrant, weakening, and so on. You can see how the stock has performed over time, depending on what quadrant it was in. And then here I have a moving average there. So for instance, if you're an intermediate term trend following investor, you might not want to own a stock that's trading below its 10-week or 40-week moving average or trending down just because it's outperforming or it's coming out of that lagging quadrant, for instance. So let's change gears and talk about exit strategies. So we talked about building portfolios using relative strength, screening using rate of change. We've talked about doing the same thing using point and figure matrices, and we talked about relative rotation graphs. Let's talk about how to get out of the positions we own. And I'm going to use the simplest to start. So the simplest, although the most manual way to determine when you want to get out of any position, let alone the market, is just using simple higher highs and higher lows, because that's what an uptrend is. So if we go back here to March of 2019, we've got a low here, a higher low, and then the market popped, it pulled back, bounced again, but we got a lower high, but it did not get lower than this other major low. So we could draw a line here and say, okay, we want to watch that level. Then it went higher high here in July, August, pulled back, could not get below this line in the sand, met that high here from August here in September, pulled back, created a higher low in October, went up, had just a 3-day drop in December, and then continued higher into the new year, printed another higher low, peaked out, and then the COVID crash happened. And you can see if you're really, really, really conservative, you can see that maybe you could have sold. It's a whole lot easier to say now in hindsight, of course, but you could have maybe sold on this second close or at the end of the week, or maybe on this pop right here and gotten out of the market perhaps. Your model has to be repeatable though. It has to be simple and repeatable. So here the market goes down. Now we got to figure out how are we going to get back in? Well, we want to look for our first higher low. So here's obviously the COVID bottom. The market pops, we get a follow through day. Here's a higher low. And now we've got a ceiling of potential resistance that the market breaks through. It continues higher. Well, it stops here, comes down, stops again. Now we've got another higher low we know about in hindsight. So that could be our next line in the sand. Breaks through again that area, which is in June, by the way. And this is when most trend followers probably started getting heavily, if not 100% back into the market, by the way. And then from there, you can see kind of how this plays out. And then if I go forward into the present day, you can see here we are in July. You can draw lines in the sand at every higher low. And then you've got here at the beginning of 2022, this breakdown. And then the market just couldn't seem to get back above on the S&P 500. It couldn't get back above 4,600. Then it fell and broke through the 4,100 level. And then we just have a series of lower highs and lower lows. So what we're looking at right now at this instance actually is we're looking to see, okay, we got a higher low in the short term here. We have an equal high just this past week, but can we get a higher low and a breakout to start challenging this downtrend that we've been in, this bear market? So that's the simple stuff. Now, when it comes to stop losses, we can get a little bit, I hate to call it more complicated because I feel like drawing manual trends is already, or I'm sorry, drawing manual horizontal levels of support and resistance is subjective, first of all. And it's also very, very manual. You know, you have to keep track of it. And in real time, it can, again, be very subjective. So one of the things you can use is something called a Chandelier Stop. I'm using stockcharts.com here because it's free. Anybody can use it. You don't have to have a subscription, unlike Optima or Dorsey Wright, for instance, which I showed earlier. So you can see here, if you go down on the bottom pane of stockcharts.com, you pull up any stock you want. I pulled up the market here, the S&P 500. You can just go down to overlays, change it to chandelier exits, and then from here you can change your parameters to whatever you want. And you can see how the chandelier exit will rise with the price of the stock and it'll fall with the price of the stock. And it just stays a certain distance away from wherever the stock's highs and lows are. And so you can see that sometimes it can get you out at good times, other times it might be a head fake. And I guess that's another lesson we need to always be cognizant of in trend following and trading for that matter, is that there's going to be whipsaws. And whipsaws meaning there's going to be times when you sell, but then you have to turn around and pay higher prices to get back in. And that's just the consequence of trying to avoid larger losses. You can't get emotional about this stuff. Another way, and I feel like this is even simpler than Chandelier stops. This is one of the stops that I like to use, is just a 40-week moving average using a weekly chart. So what you're looking at here is the S&P 500 with a weekly chart. If we go back in time, you can see it would have kept you in the market for the most part during that early part of 18. And then it would have been out here in October, call it fourth quarter of 18. Into 2019, however, you would have missed a lot of the upside because again, you can't curve fit here. You can't make this perfect. There's no such thing as changing time frames, unless you have a time machine, of course, but you can't change time frames over and over again because you don't have hindsight at your disposal. So here we would have, purchased at the same or roughly higher level than where we sold, and that's if you didn't count these whipsaws. Then you can see here there's one close below the 40-week here, which might have gotten you into trouble because obviously the next week was a big hollow positive candlestick. And then COVID, you got those big drops because the weekly candles are obviously going to be bigger than your daily candles because we're looking at a slower time frame. But again, you go current day, 2022. If you're using a 40-week moving average, it's kind of like the same math as the 200-day moving average, by the way. Then, as I can't remember who said this quote, but somebody said, nothing good happens below the 200-day moving average, which is, again, the same as the 40-week moving average. If you're a little bit more nimble, then perhaps you might look at the 10-week moving average. It's a lot faster. As you can see here, it's going to be tighter to price, but you're also going to get more whipsaws. You're going to be doing more getting out and getting in, which could create more situations where, again, here, you're buying high and you're selling low again. So that can create issues. But long-term, it can work out for you as long as you have a good set of rules. And again, so important you stick to those rules. Here's a 40-week moving average showing you the 2007, 8, 9 Great Recession mortgage crisis. Drop was almost 58% on a daily range. And again, this would have gotten you out of a lot of trouble if this was one of your filters. This is a 10-month moving average. So this is really, really slow. This is a super, super slow moving average. Every candlestick is 1 month. And I believe it was Meb Faber who made this famous. But if the market is below the 10-month, the general rule here is you would not be in the market. So here a few months ago, you'd have gotten out, paid higher prices to get back in, then you'd pay lower, then you'd have to sell at lower prices again, but you'd be out right now in a trend following model, that is. And then I'm not going to spend too much time on this, but the next exit strategy you could use, it's a lot more complicated, much more advanced traders, advanced investors, take some calculation and good software, is something called an average true range stop, or ATR stop for short. I've included the Optima code for the ATR. This is a 5 ATR 20. Actually, this is 8 ATR 20, but you could use 5 instead of 8. But what you're looking at on the chart here is a 5 ATR 20 stop. This is the math, which we're not going to go over that at all. But the average true range just gets rid of the gaps in historical price. So what this does is it looks at the average true range, and then we're looking at how many ATRs, how many average true ranges away from price do we want to be, in this case, 5 on the chart, 8 in the code. And then when it falls below that level, perhaps that's where you stop out. Here's some other examples. Ford Motor Company. Here's what a 5 ATR 20 stop looks like on Ford. And you can see how it falls with the stock price over time. Here's the same thing. This is with ARK. This is with Kathy Wood's ARK Innovation ETF, an ATR stop. This is 5 ATR 20. Would have gotten you out of a lot of trouble. And then we're back to moving averages again. This time I used a 200-day moving average. This is the ARK Innovation ETF, just using a 200-day moving average, and that's it. Pretty simple, but effective. Let's change gears again. I got to keep moving fast because we're closing in on the end, but I want to go over using ranking as a risk management tool. What I mean by that is instead of or in addition to using stop losses, you can actually use ranking as a way to stop out of positions. And here's how that works. Using a rate of change screen, what we could say hypothetically, this is the NASDAQ 100 ranked using a 26-week rate of change and then broken down into deciles. We could buy the top 14 stocks in that screen. And then what we could do is we could sell them when they fall below the 6th decile. So in other words, in this case, it'd be if they're performing outside the top 40%, that could be our sell signal. So instead of having a line in the sand, like a trend following moving average or ATR stop, we could just simply have a ranking system. If you want to be even more conservative, you could use the ranking system plus a moving average so that you're staying invested in the playoff teams, while at the same time, if you don't want to be in something that's on an absolute basis going down, you can stop out that way. Here is staying invested in the playoff teams using a point and figure matrix. This is a point and figure matrix looking at all 30 of the Dow components. The top 5 stocks are United Healthcare, Travelers, Chevron, Coke, and Apple. We could own those top 5. And then what we could do is we could sell any one of those investments when they fall below the 50th percentile. So we could say if it falls below 15 to number 16, we're out. And again, you could also add another filter if you wanted to be more conservative. And you could say, if it falls below the 40-week moving average at the end of the week, then I'm out. I think I already said this, so this is redundant, but you can combine ranking and stops, like I just said, combining a ranking system that allows you to stop out of your positions in your portfolio on a relative basis with a trend following system that protects against absolute return and creates additional defense in terms of risk management. So for instance, United Healthcare is a top ranked investment in that Dow, that point and figure Dow matrix I just showed you. So here we are, United Healthcare, top of the matrix. And right now, here's your, and there's a 200-day moving average. No reason to sell this, not from a ranking standpoint and not from an absolute basis. However, when we look at Goldman Sachs, if I go back, let's just say you owned Goldman Sachs because it used to be top ranked, but now Goldman Sachs is a 10th ranked investment inside the Dow Jones Industrial Average, and you're waiting for it to fall below 15. If again, you have to set these models in advance or these rules in advance, but if it hasn't fallen to 15 yet, but you're using a moving average stop, you would have been out of the stock when it gapped down here earlier this year. So I hope all that makes sense. Just a few closing comments, rules, and it looks like I'm actually going to close up on time, which is incredible. I'm terrible at staying on time with presentations like these. But the first thing, couple just tips. Patience is a virtue. Remember, when using relative strengths in a properly built and tested intermediate or long-term portfolio model, it's important to give your positions room to move. You can throw those extra filters like stop losses on there if you want to be more conservative. Just don't get frustrated. Just know that you made that decision to be more conservative and that you're going to wait for that position to recover before you buy it again. Or you can just not sell it and you can stay with what's strongest, and that's going to work too. And I guess that's the point here, is that all of these strategies will work over time. They're just not all going to work all the time. Next tip here is there's no magic pill. You can't have it all. There is no portfolio management strategy, tool, indicator, or model that will miss all the downside while capturing all the upside. That should go without saying. And I think we all know that, but sometimes we don't all act like it, if that makes sense. Never ever curve fit. This is huge. When you're testing a model, when you're building a model and testing it, implementing any changes in order to make historical performance appear perfect is only going to work in the future if you're lucky. And that's it. Otherwise, it's just not going to work, because you cannot curve fit. You can't make history looking at moving averages and ATRs and say, well, I've picked the perfect ATR based on the last 3 years, and I'm going to start using it going forward. What's going to happen is you're just going to get frustrated. You got to follow the rules. Again, we started with that in mind. We're going to end with that. So if you build a robust portfolio model, whether it implements additional risk management measures such as trend following, for instance, or not, you must take the trades, ignore the whipsaws, and you got to trust the model you built. If you want to update that model once a year, twice a year, there's nothing wrong with that. In fact, it's advised to tweak your model, but you're not looking for huge changes. You're looking to tweak it and improve it in small ways, understanding that at a certain point, you're going to hit a plateau, and there's not going to be much you can do to make it better. None of us have a time machine. And then if your model doesn't work, either it was built using flawed research, the strategy is not robust enough, or you're not following the rules. So a robust portfolio model will work over time, and if it doesn't, it almost always is due to emotion and user error. So it's not technical analysis that doesn't work. It's usually the individual using the strategy. So again, I'm finishing with the quote of the day. A mistake is when you don't follow your rules, and if you don't have rules in trading, everything you do is going to be a mistake. Van Tharp. Last couple slides real quick here. Always be learning. I know I am a student of continuing education. For those that are interested, this is the research that I subscribe to. I'm not going to talk about all of it. It's here in case you want to take a screenshot or look back on the recording and you want to check out these pieces of research yourself. They're all wonderful. And then these are all my friends and people I respect on Twitter. I feel like in certain industries, there's a lot of egos, but in the technical analysis and trading industry and the portfolio management industry, it just seems to be that while there may be egos, everybody's willing to share their secrets. So people are, when you go to, for instance, a CMT conference, and we're hanging out with a bunch of other chartered market technicians, it's funny how we all tend to just share our mistakes first before we do our successes. So if you're interested in Twitter and following any of these people, they'd be good people to follow. So I'm going to end with that. If you have questions, I'll bring the slide right back here, but I always like to end all of my presentations with the same Chinese proverb, and it goes like this: if you know, but you don't act, then you don't know. So all I'm suggesting is now you know. So I hope you enjoyed the presentation. Here's all my disclosures that I need to make sure I put up here. And then I'll put the Q&A or the contact screen up now. And then if there's any questions, I'm happy to take them.
All right, Adam, thank you very much. Very informative presentation. We are over time now, but thanks for our attendees, and we've got more content coming up.